Londra'dan herkese merhaba. Bu bölümde Londra'da değerli bir yayın konuğumuz var. Wietoska ile buluşuyoruz. Kendisi Deutsche Bank'ın Doğu Avrupa, Orta Doğu, Afrika ve Latin Amerika Araştırma Direktörü. Hi Christian, thanks for joining our program.
Thank you for having me.
Actually, we are coming towards the end of summer period. I would like to ask the big picture. What is the first and foremost thing when you look at this big picture in the markets in general?
Yeah, a lot has happened over the summer once again. So the world is spinning. So a lot of different developments. On the one hand side, we still have an ongoing conflict in the Middle East. Never-ending war. We're still talking about the same thing. There were some positive developments of a potential peace deal, and then still it looks like we are still struggling to get an outcome here. That has led to another spike in oil prices. They have spiked in July, and also in the last couple of weeks have been rising once again. This, of course, keeps markets busy, and of course, now going into the winter, it's a big challenge across the world as a lot of the storage facilities are very low, in particular in Europe and China. And at some point, they need to be filled after the summer. This could lead to much higher costs for consumers in the medium term. So this remains a big risk. Equity markets don't care at the moment. They kind of in a different world because they look at AI, where we're seeing a lot of investments still going through. The corporates who are reporting have seen very strong numbers. So far, all this is moving that equities are a bit disconnected from the global macro developments. And on the other hand, of course, the Fed. Everyone is puzzled about what's the next move from the Fed. Are they going to hike or not in September? And I think this is another question mark. And the summer has been very favorable for markets for carry trades, simply because because the Fed has not hiked rates in July. We have seen weaker data out of the US, and this consequently led to markets pricing out the possibility of a September hike. So these are kind of the key questions, same questions pretty much that we have had 2-3 months ago. On the one hand side, Middle East. Second, what's the Fed going to do? Third, is the AI trade continue to work? And so far, the latter is definitely the case. Question marks around the Fed. And the Middle East hasn't been solved yet.
Yeah, the markets are shrugging off what's happening in terms of war. But what do you think the central banks will do? I mean, do you expect a rate hike in the Fed? Do you think that the answer is more easy when we're talking about ECB?
So the reaction function of the ECB is easier because they have clearly communicated it, that if oil prices continue to rise, if gas prices are higher, if there are concerns about second round effects, the ECB will continue to hike rates. And we still expect in September 25 basis points hike. Inflation in Germany was slightly higher than expected in the last print. The data out of Europe were also resilient. So if oil goes back another 5-10% higher, I think it's more or less a done deal that the ECB would hike another 25 to the upper end of neutral, which is 250. There is still upside risk for another hike later on, but that all depends on energy prices. On the other hand, for the Fed, it's more complicated because the data that we have received, the NFP was weaker than expected. Latest data were also slightly lower. So the CPI print was in line with expectations. So there are both sides. On the one hand, you still have the challenge that inflation has been running well above the target now for almost 50 months. On the other hand, you have basically a slightly weakening local domestic economy. So it will be interesting to go into September. We still call as a house, as Deutsche Bank, for a hike in September, followed by one more hike from the Fed thereafter in November. So, but definitely there are arguments why it might be that the Fed might delay or not hike in September.
Yeah, so we have to watch the central banks very closely. What about our central bank in Turkey? And last week, it was the inflation report we have followed. Do you think central bank is hawkish or dovish?
So as I've highlighted over the last few months, my argument was still that the CBT is in an easing cycle, not in a hiking cycle. And from an inflation perspective, there's no immediate trigger for the CBT to the need for more rate hikes. The only reason for tightening monetary policy conditions would be if we have massive dollarization, which has not happened. So given the inflation dynamics, and I think the central bank has also communicated that inflation is sticky. is unfortunately very high and above 30%. We think it's going to end 30%. The central bank has revised it from 26 to 28, but it's more or less close to 30%. That still justifies a potential monetary policy easing or a shift towards a normalization in terms of the rate easing cycle. On the other hand, financial conditions are very tight domestically. If we purely look from a domestic demand perspective, rate hikes are definitely needed. The only reason we haven't seen any normalization yet was the recent spike once again in oil prices. But if you take a broader view at the situation in Turkey, gold prices have been rising. We haven't seen any dollarization. The FX reserves, gross reserves, are back at 180 billion, net reserves at 50 billion. So the buffer is definitely there for the central bank to be able to offset any external pressure. And considering that, we believe in September the CBT will now normalize rates. So that means that will bring the funding back to 37%. And that then opens the door for a potential cut at the following meeting by 100 basis points, and even maybe another cut later on this year at the last meeting to 35. But our house call so far is 36%. Anything beyond that would depend definitely on the external backdrop on what happened with the oil.
So before the 10th of September, which is the central bank decision rate day, do you expect this normalization in the funding? Or
our house view is right now that they're going to announce it at the meeting in September. There's no need to do it earlier. We have seen it in July. Most investors, us included, initially expected the normalization already in July, and then we saw the spike in oil, the very unfavorable external backdrop, and the central bank could not act and could not deliver. So why, now doing with this uncertainty, and everything can change from one day to the other, I would not, if I were the CBT, I would not deliver the easing or the normalization before the meeting. I would wait until September meeting, announce it then, and I think this would give markets clarity.
Can you say that the normalization in the funding will be the start of an easing cycle in Turkey?
In my view, yes. So this was a defensive move when they tightened funding to 40%. But it's now, if we look at inflation, which is slightly above 30%, around 32%, still the real rates are very high in Turkey. So not as high as in Colombia, not as high as in Brazil, but even if we compare it to other high carry countries like South Africa or relative to Egypt, Turkey has very high real rates. So our view is, unless there's a material change in the external backdrop, this is the beginning of an easing cycle, a gradual, very gradual easing cycle. It's not going to be easy, and you cannot over-deliver too quickly. But I think we are on track to see rates in 6 to 12 months lower than where they are now.
So after this inflation report, you haven't changed your expectations in terms of year-end inflation, as far as I understand, because you have already changed it in July, right?
Yeah, so the inflation report was more or less exactly in line with our expectations, as the central bank clearly expressed a cautious view on paper in the statement, but also acknowledged the tight financial conditions and the fact that they are now ready, slowly preparing for easing. So everything is more or less in line. Yes, their forecast is 28% only by the end of the year. Ours is 30%, but I think it's not too far away from it.
So what about growth and current accounts?
Yeah, so the growth outlook is challenging for Turkey. Due to the external backdrop and very tight financial conditions, we are expecting now growth at 3%. If oil stays high for longer, there's definitely room for downside surprises to that. We are now seeing more fiscal support in the second half of the year, so fiscal deficit this year around 3.5%. This seems to be the case in a lot of countries in the world where we've seen a rise in the fiscal deficit. So Turkey will be around 3.5% this year. We are also forecasting a number slightly higher for next year. Current account close to 3%. Negative this year. So it's manageable, absolutely manageable, but it's definitely a bit of a rise compared to last year.
So you haven't downgraded your growth expectation after the inflation?
No, right now our forecasts are still the same. We are a bit in a wait and see mode as we want to see what happens on the external front, but we are basically still painting a slightly more constructive view for high yielders in emerging markets for the second half of the year. We still think that real rates of countries with high real rates and very tight financial conditions have room to gradually cut rates, as long as there's no immediate domestic room for domestic shock or uncertainty, and we are not seeing that in Turkey right now.
What about dollar TL expectation year end? And do you expect any, acceleration in the depreciation of TL?
So that's a very, very good question. So we are still forecasting 51 by the end of the year. So that would mean in real terms appreciation. So our argument is that during an environment where oil is potentially falling, there is a bit more room for faster depreciation. While on the other hand, because the currency is, to be very fair, it's not cheap. It's in the global context, it's a bit more expensive now. But if there is like a acceleration in the pace of the the strength or the rally in the oil price, I would say that the central bank will keep a very tight ship and will continue to manage the currency very closely. Right now, we still haven't changed our view on a gradual, continuous, nominal terms depreciation, but still real appreciation is needed to get inflation back towards 25 and at some point, hopefully 20%, but it is still far down the road right now.
What about the perspective of foreign investors to Turkey? Where exactly the foreign money going? Carry local equities?
We have the numbers. We are around 50 billion right now in terms of the carry trade. And I'm just back from a trip to the US and I was amazed how many investors in the US were still very long carry, very long in Turkey. They are mostly investing in the FX and in the floaters, in the floating rate notes, which makes sense in an environment where rates remain high. And the central bank is not in an easing cycle, as they will outperform relative to nominals. Given my view and our house view that the central bank is now starting to normalize rates, we could see a shift out of the FX trade into the nominal bonds. Historically, it's always the case that during an easing cycle, even if it's just a gradual easing cycle, that nominal bonds will outperform relative to FX. And I think this is key also for the funding and to get these the foreign flows into the bonds. Right now, most of the money is still in the FX trade and in the floaters, and investors still struggle with massive inflows into the equity markets, given the weak growth dynamics and the bit of underperformance we have seen in equities over the last 12 months.
So last question, what is the biggest risk in this picture?
If oil prices, because the situation escalates in the Middle East, goes to 150 or 200, this would be the biggest external risk. For Turkey, we don't worry about the Fed, whether they hike 25, they had 50. This is something that matters for the low yielders, like in the CE region. This matters a lot more for Mexico or South Africa, but not for Turkey. So the bigger risk is that oil prices stay elevated for longer. On the domestic side, another risk would also be, of course, anything around an early election. So if this announcement would be coming now in the October, it's not our base case scenario, but if this would be announced now, we can see that a lot of other countries this year, including Brazil, including initially Hungary and some other countries, when the announcement came of an early election or the election, that the markets is always a bit cautious about it. We are still calling for an election in late 2027 or early 2028. So it's not any kind of scenario that we would call right now as a concern. And this is why we are very constructive on local bonds and very constructive on local assets in general. But I think this would be, if an announcement would come right now with elevated inflation and oil at these levels, I think this would be the only domestic risk that we see.
Christian, Wietoska, thank you so much for joining our program.
Thank you very much for having me.